What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 25th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to try to level with you all and be as honest as I can and talk about why I genuinely believe that we need to prepare for the next leg down, both in Bitcoin's price as well as Ethereum and the broader crypto and stock markets as a whole. I'm going to be spending some time to dive through three critical charts or key talking points that I think will start to explain why this is. So if you guys enjoy this content here, consider dropping a like. It's one of the best ways you can support the channel. And let's go ahead and kick off the rambling. All right, guys, this is one you're not going to want to miss because we're going to talk about some really important dynamics here. As Bitcoin already has recovered about 51% off of the lows and one of the fastest recoveries we've seen in the past couple of months throughout the past year of 2022. We are coming up on testing a very critical indicator here, and that's the 200-week moving average. Now, I don't need to be the one to tell you that this is going to be a very significant period of time for Bitcoin, as over the last couple of months since back in August when the Fed put down the hammer on tightening markets, this was a clear signal once Bitcoin had broken this level and trended below there for a suspended period of time that we are in a different type of bear market than before. We are in a recessionary bear market. And the question is going to be whether or not we're able to get above that 200-week and sustain above that range. I have no doubt, considering the momentum we've had, where we've generally been making big moves, holding sideways, and then pushing up higher, that there's a chance we can come up and test that 200-week. But putting aside our analysis of Bitcoin, I want to go ahead and talk about the three charts that I think are pointing us in the direction of answering that question. Can it really hold above the 200-week, not just reclaim the 200-week? That's a very big question that we need to ask. First off, I want to go ahead and analyze within the crypto markets. I want to go ahead and talk about Ethereum. One really interesting thing that we've highlighted over the past couple of weeks to watch is what happens with the ETH to BTC ratio. I know some people are like, Nick, why do I need to watch ETH to BTC? Why don't I just watch the ETH to USD pair? Isn't it fair to focus on the fact that Ethereum has gone up in dollar value? Absolutely. Watching dollar pairs is also very valuable, but we need to understand whether or not Ethereum is outpacing Bitcoin in order to understand if A, the narratives that the bulls have been chasing are intact, signaling that we're entering into a bull market, and that has generally been that Ethereum is going to be the new leading asset with its beneficiary monetary policy, and that it's beneficial to take the more risk-on asset, the lower market cap asset, if we're going into an optimistic period of time. And the second point as well we need to keep in mind as well is that whether or not these risk-on assets are going to be able to hold on their moving averages against BTC. That is an indicative sign that we are in a period of optimism in the market. On the other hand, though, we are starting to see two things. Not only that Ethereum looks still for the past year of 2022 and still here in 2023, that Ethereum has not only been overbought since as far back as 2021. Over the last 2 years, it has been in a sideways potential distribution pattern in its price. But on top of that, that we are not able to hold on the consistent 200-day moving average like we couldn't back in May of 2022 when we had the collapse of Celsius and a lot of other players in the space. Now, I want to go ahead and just talk again about what this is signaling to us. We went from a pattern in 2021 in the kind of extended bull market into November and December when we had our peak in valuations, where we were making higher highs and higher lows. And then after a period of time, we started to stagnate. We had the pullback in June, but rebounded strongly after as we went through the summer relief rally, which took Ethereum up to 2,000, where again, we took out our positions in the market. We got back into cash. And since then, the ETH to BTC ratio has been relatively neutral. If anything, it's starting to set in lower highs, signaling that this could potentially be moving lower. Now, as some of you may know, we've been talking about Ethereum against Bitcoin making a 50% pullback roughly from that high point in December 2021 or September of 2022. And while, again, it hasn't played out fully just yet, right? We've been remaining patient on this. We can clearly see, if we just take a look at price, that there's clear signs of weakness, that the 200-day is not being held at right now as we go into this week in January 23rd. And it looks like we're going to be coming back down yet again towards those 200-week moving averages, which again means that we've got a pretty decent decline, even if we don't get the full 50%, a 35% pullback from that top range in September against Bitcoin, or from where we're at now, about a 19 to 20% move. So again, I'd be really worried here if we continue to see on a week-to-week basis that this is continuing to show signs of weakness. Ethereum should be leading the way forward if we're entering into the next bull market, especially if we're seeing the kind of liquidity that's going to sustain a longer-term rally, right? Now, especially at these suspended valuations, as people have been talking about, this is something that we have to be concerned about. But the next thing I want to talk about, again, in regards to Ethereum, is the USD pair, right? It's one thing for Ethereum to, hopefully make higher lows and higher highs in its ETH to BTC ratio. That would be really great for the broader altcoin market, that we should be buying the dip on altcoins and getting optimistic. But we've not only been skeptical of that narrative, but let's just go ahead and be a bit softer here. Let's not set such high standards. Ethereum has already made great gains against Bitcoin since back in 2020, 2021. At least in its dollar pairing, we should be seeing higher lows and higher highs. And we should be seeing at least a couple pairs of it, if not at least sustained higher highs and higher lows. What do I mean by this? If we take a look at the price action that we had back on January 21st, the relative peak since we've kicked off this rally since the lows back in November, which bear in mind, didn't go back to the previous lows of June, are at a similar price point to where we topped in November before the collapse of FTX. We have not been able to reclaim the September highs or the highs back in August. Again, if Ethereum is going off of the idea that the supply shock from the move to proof of stake, which has lowered the inflation rate, and network upgrades like EIP 1559 that burn some Ethereum from the network, potentially making it deflationary, are going to be the things that carry it forward. Well, while that may be a good thing for Ethereum, we're not seeing it showcasing in price here. We are seeing it, again, underperforming against Bitcoin, not being able to get above its November or September or August relative highs when we had these relief bumps or relief rallies in price. So again, this is why I always talk about us not being out of the woods. But this is just within the microsphere of crypto. It's something that's more relevant for us because, as many of you probably know, we are mainly a crypto channel here on YouTube. But what makes us different is we're also analyzing the macro perspective. 95% of traders and investors, as well as YouTubers out there, don't really focus from this perspective. They usually think within the crypto sphere, and that can leave you in a bit of a bubble sometimes. We need to be able to step out and understand how the liquidity flows are working when it comes to equity markets, what the risk-on mentality is across the board in other assets, as well as what's really going on in the physical economy. There is a really interesting lineup here of the equity indices from the NASDAQ, the Dow Jones, to the S&P 500 that are going to answer whether or not this is a period of time to start taking profits off the table or start, again, basically holding out here and estimating that we're going to be going into the actual next bull market. And we really have this ultimatum that'll lead us into point 3 later on within the video. But again, if we're just going off of technicals here, going off of the price action, I understand it's very easy to be looking, if you're looking on the hourly chart, to get really euphoric and say, oh my God, I'm seeing that day by day we're making uptrends and we're starting to move higher. Prices are coming up, testing those moving averages. The key thing we need to focus on are what things have held price back. It's as simple as this, right? This bear market has actually been incredibly predictable versus other bear markets in the past. It has been a textbook example of what defines bear markets versus secular bull markets. Secular bull markets of the last decade used the 200-week moving average as a buy the dip opportunity time and time again, sometimes not even coming down to that 200-week and holding out, starting to move up higher. So that was the sign of the last decade, that the Fed was on your side, that every time we'd essentially get a dip in equity prices, the Fed came to the rescue. They would pivot, or they would talk softer, they wouldn't be as hawkish, right? Nowadays, because of the inflationary pressures in the economy, we've seen that the 200-day moving average is starting to serve as resistance. And on top of that, on those leading indicators like the NASDAQ that would be bought up every time at the 200-week, now it's facing consistent resistance. And we haven't been able to get above that level. And it's not a matter of just trading above there, right? Just because we go above those moving averages for a day or two does not mean we are out of the woods. It's a big misconception people have. People jump the gun to it because they don't want to miss any potential rally, right? But the name of the game is to see whether or not the price action signals to us that, hey, I'm not only going to get above that 200-week moving average, I'm not only going to get above that 200-day moving average, which are converging very close to where we are within price, but I'm going to turn it into new support. And on fact of that as well, if there are any certain lines of sloping resistance across those lower highs over time, like we got here on the NASDAQ, I'm going to turn those into support. There is someone out there that is buying at that price range. And that is all you need to know. Right? If you see those signs where that's starting to be turned into support, those indicators of previous resistance are now support, forget the macro analysis, forget what people think the Fed is going to do this and that. Market price action will tell you through these key signs that there is a much greater chance that we are moving higher. Unfortunately, to be completely honest with you guys, and this is why, again, we've still remained, you can call it pessimistic, bearish, whatever it is, right? We rode the last decade upwards in equity prices. We believe numbers go up and to the right in the long term. That being said, we have not seen those signs play out yet. And I got to tell you guys, if the NASDAQ cannot get above these moving averages and is in this similar pocket where each and every time for the last 4 times we came into this pocket, we shot down lower in price, I can't reasonably tell you guys that it's time to go long. And I will happily buy in, 12,000 points on the NASDAQ, 12,300, right? Some premium for where we are, another 10, 15%, totally fine paying that premium. So long as I know that the trend is on my side and that the Fed is out of the woods when it comes to inflation. But it's not just the NASDAQ here that is yet again in the same pocket where it is favorable time and time again to go short the market or to simply remain in cash and wait for lower prices. Other indices are showing the exact same thing. The Dow Jones as well, while it has been definitely at a higher price range than where it was back in October, showing signs of weakness here, lowering highs in price. We're not even able to get the deviations like we got before up towards around 34,000, right? Every time we're getting shot down here at a range of previous support in the past. That is not a positive sign. It's showcasing that a lot of the defensive stocks, tech companies like Apple that are incredibly cash rich, as well as the industrial companies that have been able to adjust and adapt to inflation by just simply increasing prices, those companies which had the more dependable corporate earnings are likely seeing signs of weakness. Investors are starting to price in that these companies cannot get back to their previous all-time highs. And as you all may remember, way back and about a month or two ago, and for actually really the past couple months, we've showcased how during the dot-com bubble, a 2-year plus bear market, this exact same thing happened. The defensive stocks started to outperform their weakening software technology counterparts, and eventually they still rolled over to new lows just like tech stocks, as the previous market leaders continue to weigh down overall investor sentiment. And the same goes here for the S&P 500, right? Again, I just want to go ahead, we'll turn on the moving averages here so you guys can see that, right? We are above that 200-day here for the Dow Jones. But the question is, as we talked about, can it hold above this range? That's the big question. And as we've come down and tested this range here, so far it's holding out, right? But again, pull up the S&P 500 here, get those moving averages here printed on the screen, right? We're above that 200-day. Got a lot of people optimistic. But again, as you can see here, we'll turn off our drawings. We've come above the 200-day multiple times. We've come to that pocket of the 200-day many times. The question is, can it be held? Can we start breaking away from those moving averages in a sustained way? Again, happily pay a premium. We'll be happy to admit if we get it wrong or if that, hey, we didn't get it exactly at the bottom. No smart investor or trader is focused on trying to catch bottoms. I'm going to be honest with you guys here. I'm not trying to insult anyone. I've been in the same position before as well, trying to pick bottoms, sometimes routinely just dollar cost averaging. And yes, sometimes over the last secular bull market over the last decade, that's usually what you want to do, especially when you get those 20, 30% dips, so long as you knew that the Fed could come to the rescue. But we have the pressures of inflation, and we're likely looking about entering into a real recession where the Fed cannot protect equity markets, it cannot protect the real economy. Something likely will break. That's not me being overtly negative. It's just understanding this next third point that we're going to be talking about, which really plays into both of the charts we've just looked at. This, if you guys have stayed around, this is really the big thing here. The Federal Reserve is going to be meeting January 31st to the 1st. Likely they're going to have the FOMC meeting probably on the 1st. It tends to be that the second date they have is usually when they actually have it. I don't know if the Fed's running behind or if that's just how they separate. Sometimes they have their meeting minutes released before as kind of a precursor to the meeting, giving a little bit of hints or some of their thoughts and details. But put aside that, we know that coming up here towards the close of the month, right, towards the beginning of the new month, we are going to have the FOMC meeting. There's a lot of optimism riding in here. We've got the S&P 500, Dow Jones, the NASDAQ, all trading at relatively decent levels, as well as euphoria in crypto markets, the more risk on asset class. And I want to make it very clear here, over the next coming days, prices could continue to move higher. We talked about it at the beginning of the video. Bitcoin could come up here towards 25K. It could come up and test those major moving averages. But the question is, can it continue? And that has a lot to do with what the Fed is going to talk about. I got to first share one thing here that is really concerning. We take a look at the CME Group prediction markets around the Federal Reserve meeting. A whopping 98.2% of participants believe that there's a probability of the Federal Reserve only increasing by 25 basis points. Maybe that's not the best way to put it. Generally speaking, the markets are predicting a probability of 98.2%. The Fed is only going to increase by 25 basis points. After already cutting down from 50, 75, they believe we're going to go from rather these 75 basis point or 50 basis point increases, we're only going to increase by about 0.25%, roughly speaking, for the indicator, for the Fed funds rate, for the cost of capital, the base cost of capital. That is overwhelming confidence that the Fed believes that its job is done and that it's going to stop its tightening cycle very soon. And if you look at the forward months here, if you look at March, right, potentially looking at the next FOMC meeting in late March, many people believe, again, that we're starting to even get to a point where the Fed may flatten. About 20% of the market, about 17% think that this next rate hike of 25 basis points will be the peak rate hike. And that the Fed will just stop there and keep it there. So markets are already pricing in a very optimistic Fed that has gotten inflation under control and that the job is done. And we've talked about this for some time. We did predict that somewhere around 5% would be the peak rate, somewhere within this pocket where we were back in 2006 and 2007. Whether or not the Fed is a little bit lower, a little bit higher, we need to really talk about the reality of Fed pivots and the effect on price, at least over the near term on the macro scale, over the last few decades, right? Let's take a look at a really interesting chart. What we've got is the S&P 500 printed out here and the federal funds rate, the effective federal funds rate. Now, we don't have all the price history here. The effective federal funds rate is updated more frequently, so that's why I prefer to use it here. We get much more update information on the current rates. But on top of that as well, this is going to showcase us. It's very valuable here in showcasing how markets react with Fed pivots. A lot of people think that generally speaking, that if the Fed stops rate increases, that equity markets are going to respond positively. But in reality, what we find is that when the Fed starts to lower rates, that is more of the catalyst or sign that equity markets are in for trouble. That essentially we are entering into recession. For example, you take any period of time here and go back in the 2000s, the vast majority of the declines in the S&P 500, not to mention the technology stocks as well, came in after the Federal Reserve dropped rates from around 6.6% all the way down towards around 1.5 points, right? Or down here, for example, in late 2002, right, where we took rates down to about 1.3%. Or here in 2007, when rates went from about 5.3% after flatlining for an entire year and going down towards practically zero. So we can see in the last two recessionary bear markets, which I think it's pretty obvious by now, we are in a recessionary bear market. That the last two relevant ones over the past few decades signaled that prices only bottomed well beyond a Fed pivot. The point I want to drive here is that we not only still have a few rate hikes to go, in my opinion. I think we're going to go up towards around that 5% target. The Fed Watch tool here, again, I think still is pricing in decent estimations that we're going to get around this range, right? But we're starting to see, again, some people getting too optimistic, thinking that that peak rate is in, right? The key point is this, that no matter where it goes, it is going to have to stay there for a long period of time. Now, the prediction markets start to assume, if you kind of go out into the future here, at that rate has a good chance as we go throughout 2023 of staying there, potentially starting to decline over time. This goes off of some of the comments from the Federal Reserve. But the key thing is this, we've got an entire year where we are probably going to be pushing sideways after getting towards that peak rate. And what are equity prices going to do then? You've got month by month by month, tens, if not hundreds of billions of dollars of quantitative tightening, rather than just keeping the balance sheet straight, or quantitative easing, which propped up equity values over the last decade. You don't have that anymore. You have the complete opposite. You have liquidity contraction. You have automatic cash being withdrawn from the market, unloading of mortgage-backed securities of U.S. Treasuries, which is going to absorb a lot of the liquidity that may originally go towards equities. That's not good for equities. That's not good for crypto. And you have interest rates at a much higher suspended rate than they were over the last decade, where they were practically 0%. Now it costs about 5% at its base level to borrow capital to expand or explore in buying in financial assets. It's not rocket science here, guys, to understand that if you fight against the Fed, you're likely not going to be in good hands. That you're going to be going up against a lot of stiff competition of liquidity contraction, of weakening stock buybacks due to weakening corporate earnings and economic growth, and therefore weaker economic projections. All of these things are likely not only going to weigh down equities, they are going to weigh down Bitcoin, Ethereum, and your favorite altcoins. It's as simple as that. We've got altcoins we like here on the channel. We've got cryptocurrencies that we like. I like Bitcoin. I like Ethereum. I don't have anything negative against these. It's what our channel's been based around for the last few years, since 2017. We've been around the block here tracking crypto markets for some time. But I got to be honest with you guys, I'm not here to tell you all. If we've already started to see contraction before the Fed has pivoted, what is it going to look like when the Fed has to pivot? What's going to break that's going to make the Fed start to do as it's done time and time again, where it has to lower interest rates sharply? Especially considering here that the Fed probably can't pivot so aggressively, because their main focus at the end of the day is to keep inflation lower. It's as simple as that. And so many people can end up forgetting that because they think about what can happen to the upside and not what can happen to the downside. It's as simple as that. That's the defining trait between good investors and speculators. And I'm not here to say that if you guys believe the market it has bottomed, that you're a speculator. Right? I'm not here to insult you guys. Right? I'm just here to say that we have to get out of that mindset of chasing every single rally, thinking that the Fed can pivot on a dime. Inflation is real. And the inflationary pressures of the last few years, the absorbent amount of money the United States Central Bank and other central banks across the world created is going to take time to unwind. And no matter which path we take, no matter how harsh it may be, we are still a long way from where we need to be. Anyways, guys, that's it for today's video. I rambled out a good amount. If you enjoyed this video, guys, consider dropping a like. Whether you agree or disagree, I want to hear some comments down below in the description. Get some thoughts from you guys. Hear what you're looking at the market right now. Feel free to just get a discussion going in the comments. I love hearing from you guys. Thank you all so much for giving me some time to ramble, some time out of your day. And I hope you have a wonderful rest of your day. And until the next one, I'll see you all in the next video. Take care, everyone.